Let's do our calls of the day now. First, Conocophillips named a top pick for the second half of the year, Goldman Sachs. They call for a more than 20% upside. Joe, you own it in the Joe T.
Amongst a bunch of other names, I highlighted it yesterday as a name to own. It also has a little bit of a refining capacity, which gives you a diversification in the energy production model. It's a name that has pulled back since the fall, but it's a name that I believe you stay with. Reasonable valuation, a company that's seeing the profitability at historically high levels, and it's a company that I think viewers, if you don't own it, should take a look at.
Down 14% year to date. It's 19% in 6 months, 27% off its 52-week high. Oil is, 72. Why here? Why now?
Well, I think, the time frames that you're citing, I said in my initial remarks, the stock is off its lows from October. You want to pull back the lens and go all the way back to...
it's only up 4% over the last year.
Okay, but Scott, this is a stock that was $20 in 2020.
Okay.
It's had a remarkable run, which is correlated to a significant reversal in the incentive to increase production. It's a well-managed company, and it's a diversified company, and it's a diversified energy company. And I think those types of companies are the companies you want to own when you're experiencing some of the volatility that you're experiencing in the spot price of oil.
So the price of oil doesn't matter to the price of this stock?
No, the business is diversified enough.
Okay.
Over 1 year time frames, there is no correlation between oil prices and oil stock prices. Joe is correct.
All right. You own some of these names, not this one specifically, Jenny, but you got a lot of exposure in the space.
So Josh said something really interesting about PayPal, which is, I think, true for the energy space, too. He said they didn't put out earnings that were good enough to meet expectations of the people who had bought it 4 times higher. And I think that there was a big rush into the energy stocks last year because people followed that big plus 50% year in 2021, the plus 50% year in 2022. And now, when these companies are doing exactly what they should, which is minting cash, buying back shares, paying out big dividends, creating reasonable earnings growth, not huge, now there's just a shareholder base turnover, right? But if you get in now, there's probably a lot of money to be made. You're not going to have 50%, but you might have 10 or 12%, some combination of capital appreciation and dividend income.
Energy is the worst sector in the S&P.
It goes in and out of favor, and I know there are people that sell their ability that they can time sectors perfectly, and they're only going to buy the 3 leading sectors, and they get out of the 3 laggard sectors, and they can do that on a reliable basis. I know you can't do that, but there are people that will believe them. I don't think that that's necessary here. I completely agree with Jenny. It's out of favor. So if you don't have exposure here, they'll come back in favor. That's not when you want to buy. So I would be looking at the stocks that make up this group. And they're not all straight up buys, and they're not all necessarily done going lower, but so what? There's risk involved.
What about Joe Ingersoll, which was upgraded today at Evercore to outperform? Price targets a 20% upside from here at $71. You own this in the Joe T as well.
We do. Trades at 30 times. Jenny, it's got $2.2 billion in cash, which I think you'd like. Organic revenue is about 30%. Significantly outperformed the S&P over the last year. It's up 29%. Again, a very diversified business. And it is an industrial that's been well managed in understanding how important it is to be diversified in the industrial sector. So it's a name that has been with us since July, I believe, of last year. We got in somewhere around $50. I don't know where the chart is, 59 right now. Strong balance sheet.